As always, thank you very much for your time and good speaking with you.
Thanks
indeed.
Thanks.
Thank you. Well, 40 points lower on the Nifty is what we have. Now we're at the low point of the day. So 17,800 is the low. We're at about 17,804. And I think you got a similar kind of picture, not quite on the Bank Nifty. The low on the Bank Nifty is 40,508. We are at about 40,619 or so. The Nifty, yes, at the day is low. The Bank Nifty, not quite. Our alpha manager of the day is with us, Amit Gupta, is Vice President and Fund Manager at ICICI Securities. Amit, it's always a pleasure having you with us. Good speaking with you. So tell us, Amit, where are markets headed? First of all, directionally, do you have a firm view that this will be a risk-off phase, perhaps some more price damage, or something else? What's your view?
So I think it's a this is how the market has been behaving for the last many months. That generally the correction of more than 1,000 points comes, market gets a little more attractive, and then you start seeing the reversal again from the range. Now, if you see from the dollar perspective, I think dollar is topping out because euro has stopped falling, dollar has stopped moving up. And on the top of it, if you look at the premium of Indian markets over the emerging markets, actually has reduced from 85 to almost 62 now, because Chinese market had moved up and they had moved up by more than 50%. So that is where our expensiveness actually has reduced over the emerging markets now. And another thing is that we are coming closer to the 5-year average price to earning, which is almost 18.5. And this is a good period, 5-year average. And I think that is where if somebody starts investing, so some more downside, some more correction, or sideways movement is possible. But if you start investing here, I think the money making can be better if you are looking for beyond 1 year period or possibly 2 years period. So that is where I think the market is getting attractive. The trade deficit also has reduced from $23 billion to $17 billion. That I think can cushion some kind of rupee weakness, which has been very sticky for the last few weeks.
All right. Hi, Amit. Good afternoon. Amit, the PE, I take that point that it's at around 18 times. My only worry is on the E part of it. Maybe earnings may not live up to expectations, but time will tell on that front. From the money that y'all are managing, what are the new stocks you're buying into? Or if the markets go into that sideways, a little bit jittery kind of move, what are the key stocks you're looking to buy?
So, see, one theme is when we look at the CapEx story, for example. So in CapEx, for example, take the case of cement. Now, people were asking that when we have so much of CapEx by the government, why the cement stocks are not participating? So there are two ways to look into this. One is because there is very high capacity addition which was happening in the cement, and we saw that it was more than double in some cases, from 70 million ton to 140 million ton in the case of ACC Ambuja, what they are projecting for the coming 3-4 years. Ultratech Cement, which is sitting at 130 million ton, they were talking about to reach to 160 million ton. So when you have a supply so much increasing, which is almost 13-14% CAGR, and the demand, because demand is divided between infrastructure and real estate when we talk about cement. And real estate is not firing from all cylinders. It is few pockets which are definitely emerging. But yes, that is why the demand is growing by 9% or 10%. So you have some mismatch between demand and supply. And that is why cement stocks were not coming that much good. But because the petcoke prices actually we declined previously, we saw the margins were coming better, and now they were able to increase the prices. So there are two ways. One is you can look at some of those efficient companies who are possibly not going into very high huge capacity expansion like Shri Cement, but they were always at a premium valuation, which the premiums actually have shaved off. So those companies actually have come down to good levels, and from where I think we have started again averaging those positions, though Shri Cement was part of our ACE equity portfolio. Another thing is that we are looking at that the companies who are the material providers to all of these OEMs. So ultimately capacity expansion is happening across the board. So the supply is higher. So there are companies like AIA Engineering, for example, which is a 1979 Gujarat setup, very excellent track record. And this is a company which is into the grinding mills, high chrome grinding mills. They are doing much better. Their results are coming much better. And I think going ahead also, these companies are likely to give you better results and they are the direct beneficiary of this capex cycle.
Got that. Amit, good afternoon. I'm just looking at the screen right now, probably pertinent to pull up Reliance Industries. Let's get the intraday chart up. Reliance is making a little bit of a move. It's something very dramatic, but there's some sign of life on that stock. Last 2-3 sessions, it's managed to cross above 2,400 once again. And it's because of Reliance that the market isn't getting into a wider fall. In fact, we're back at the flat line. And that's largely because of the contribution that's come in from this big boy. Amit, what's the sense? There's so many triggers ahead. I mean, whether you're talking about the telecom business or, you look at what's happening with the core refining. But the stock has been so range bound. It's only now that it's looking at, climbing above 2,400. Over the next 1 year, what would you expect from Reliance, and would you be a buyer at this price?
So my sense is 2,300 around where the stock had declined. I think there is a very limited downside from here. It is always a matter that when the growth in the price is going to come. So my sense is not 25% of Nifty is going to be occupied by Reliance and HDFC Bank after the merger of HDFC Bank with HDFC Limited. And both the candidates, they were not performing actually for the last many months. And we believe that they are coming up now. And the money flow into the emerging markets will come, because if dollar is topping out, money will start flowing into the emerging markets. It is looking for value pockets. And I think that is where those heavyweights which were not performing, HDFC Bank and Reliance both, I think they are giving some kind of value now. And that is where you will start seeing the support to the index from at least these two heavyweights. Now, coming from the fundamental perspective, you are seeing what is happening in Bharti Airtel. Their ARPUs actually have gone to 193. It's a significant jump. And another kick that we saw in the telecom space is that they are scrapping lower the order prepaid prices, prepaid cards, and they are going to higher one. So, for example, what Bharti did in Haryana and Odisha, they removed 99 rupees of prepaid and they moved to 155 rupees. So there was a fear that the subscriber base possibly will come down, though you are increasing the ARPUs, but it did not happen. The subscriber base also remained very sticky. And I think this is where both the companies, whether it is Reliance or Bharti Airtel, they are be the key beneficiary actually of this move. And we have to see the applications from 5G, which are going to be used by various industries now going forward. And that will define the further growth path. I think both of them are a good price. Telecom is looking attractive, along with both of these heavyweights, Reliance and HDFC Bank.
Amit, if you just map the way telecom companies have increased tariffs in the last 3.5 years, the entry-level tariffs 3.5 years ago began at 35 rupees. That was the minimum recharge plan. And now you can't recharge sub 155 rupees. 35 to 155 rupees. That's an increase of 340% just in the span of 3.5 years. And even higher priced plans have gone up by approximately 50% over the last 3.5-4 years. So it's a pretty decent, CAGR in terms of an increase that we've seen. But wanted to get your thoughts in on chemicals. That's a space that you like. And chemicals saw massive upgrades in 2020, 2021, and even in the beginning of 2022. But just in Q3, because of higher channel inventory, because of some moderation in exports to the European markets, Middle East, we've not seen any upgrades. In fact, according to Nuvama, the overall chemicals industry of the sector has seen downgrades to the tune of 1%. Do you get a sense that perhaps the best is over and we could see more earnings downgrade for chemicals?
See, from the price perspective, I think in 2021 second half, generally most of the chemical companies, they had made the top. And then we saw almost 1 year of languish movement actually by all of these companies. And from the export perspective, as you mentioned, if you look at electronics export are picking up in India, and the other two are now going to be engineering goods and chemicals. And I think chemical space, what we like here, so we need to be a little choosy because there are many stocks. I think two segments are looking better. One is the hydrofluorocarbons, HFCs providers, for example, SRF. So they are the material provider to the OEMs in air conditioners. And you are seeing that the OEMs again in air conditioners are facing the pressure of Japanese competition. So you have seen what has happened to Voltas. So Voltas declined from 1300 to 800 because the market share declined from 25% to near 23%. but it did not impacted negatively to the material providers like SRF, which provide refrigerant gases, because ultimately they are the providers to everyone, whether it is Japanese or whether it is Indian OEM manufacturer. So that is where these B2B companies are doing much better right now, and AC has a penetration.
Okay, I think we lost the line. Amit, we'll try and go back to him.